So in today's video, we are going to talk about Chapter 9. The Chapter 9 is about fixed assets. There are three kinds of assets that we are going to talk about. One is the fixed asset, which like land, building, machine, and factory equipments, and the intangible assets such as copyright, royalties, and franchise. And the third one we are going to talk about is natural resources. So in this question, a company has accounts include land, building, and office equipment and communication equipment with a separate accumulated depreciation account for each depreciable asset. So as you know, the land is the only asset that we do not depreciate. The other assets such as building, office equipment, and communication equipment will be depreciated. And a company has a right to choose what depreciation methods they would like to choose. For example, we have discussed in this chapter three depreciation methods: straight line depreciation, double declining balance depreciation, and units of production depreciation. So it depends on the firm which one they use in terms of depreciation. So for example, in this question, L.I. Johnson on January 1st purchased office equipment for $113,000, paid $80,000 cash, and financed the remainder with a note payable. So on January 1st, we are going to enter this transaction. We're going to say debit, office equipment, for $113,000, and we're going to credit the cash that we have paid, which is $80,000, and the remaining amount we are financing, so it's going to be a notes payable. So 20 plus $33,000 will be on note payable. So this is what the entry we are going to make on January 1st. In the second transaction, on April 1, acquired land and communication equipment in a lump sum purchase. Total cost was $310,000 paid in cash. An independent appraisal valued the land at $244,125 and communication equipment at $81,375. So how we are going to do this? So on April 1st, we have paid a cash of $300,000. So total cost is equal to $310,000 that we paid in cash for two things: land plus equipment. Now, at this point, we do not know how much is the land and how much is the equipment. That's why we call appraisal. So according to the independent appraisal, we find out the market value of land is equal to $244,125. Now, the word market value is not used in the question. It uses appraised value. So appraised value or market value is almost always same. So the market value of land is this much, $244,125, and the market value or appraised value of communication equipment is equal to $81,375. And we know that we have paid 300, and so the total for these two is equal to $310,000. As you have studied before, as we have studied in this chapter, that we have to when we have given a lump sum value, we have to calculate the value of the book value that we are going to enter in our book. So we cannot enter 244 or 81,375. We have to use the ratio of these values. Therefore, we are going to take land total paid. So we're going to take land, and we're going to take which is equal to 244,125, and we have paid 310,000. So what we need to find out, we need to find out the total of this transaction, the two things that we have. So the total of these two transactions we find out is equal to 244,125 plus 81,375 is equal to 325,500. So this is what we have paid. So 325,500. So when we're going to do, we're going to divide this number by the total number and multiply by this. So 244,125 divided by 325,500, and that's 75% of multiply by $310,000. So that will give us the book value of 232,500. And then we're going to do the same thing for communication equipment, which is 81,375 divided by 325,500 multiply by 310,000. So that would be it should be 25,000 because we have only two things. So we just take 81,375 divided by 325,000. That's 25% multiplied by 310,000 that we have paid. So that gives us 77,619. Okay. So I want to repeat this one more time. We purchased two things, the land and the equipment, communication equipment, and we paid a total of $310,000. So that's the total company paid for land and equipment. So we do not know at this point how much is the land and how much is the equipment. So we call an independent appraisal, and he told us that the market value or appraised value of the land is this much, and for the communication equipment this much. So when we total these two is 325,500, but we paid only $310,000. So what we do, we basically find out what is the ratio. So we take the total land divided by the total value, multiply by what we have paid. So this is the market value, this is the total of market value of both, and then multiply by this. So this gave us 75% and 232,500. So what we're going to do, we're not going to put in our books the land at 244,125. Instead, we're going to book it at 232,500, which is the ratio of the land. So we're going to debit land for 232,500, and we're going to debit communication equipment for 77,619, and we paid cash, so we're going to credit cash $310,000. So this will be our journal entry on April 1st to book the land and the communication equipment. Again, another reason for doing these two separately, because land is a separate account compared to communication equipment. Communication equipment is a depreciable asset. It's going to be depreciated over the life of the equipment. However, land never gets depreciated. So we move to the second transaction. The second transaction is on September 1, sold a building that cost $520,000 and has also an accumulated depreciation of $285,000 through December 31st of the preceding year. So last year we have a building that was listed as $520,000, and the building accumulated depreciation was listed $285,000. Means the building that you have purchased for $520,000 in the past has already been depreciated for $285,000. So this was at the end of the last year. So what additional information they have provided? L.I. Johnson Associate received $420,000 cash from the sale of the building. So when we sold the building, we received $420,000. Depreciation is computed on a straight line basis. The building has a 40-year useful life and a residual value of $25,000. So what we are saying that the cost of the building when we purchased this building, cost or the price of the building was $520,000. The life of building was 40 years, and the residual value after 40 years was how much? $25,000. So how much depreciation expense we're going to have every year? Depreciation expense is going to be $520,000 minus $25,000 for the residual value divided by 40 years. So if we take this $520,000 minus $25,000 is equal to $495,000. $495,000 divided by 40 years, that will equal to $12,375 per year. Okay. So if you want to know how many years you have already been depreciated, you can take the $285,000 and divide this by 12375. So you have been depreciated about 23 years. You have already been depreciated. Okay. So we know two things, where we have a depreciation that we have already taken, the price that we paid, and the cash we received, which is $420,000. So first thing first, what is coming into the business of this company L.I. Johnson? So the cash of $420,000 is coming. Okay, so we're going to debit, so that's coming in. What is going out? We're going to credit building of $520,000. So if the asset is coming in at the same price, it will go out at the same price. What else goes out? When we sold the asset, the depreciation, so it's 285, so we're going to debit 285,000. That will cancel out. We have already credited this one, so that's cancel out too. So we're going to debit depreciation, accumulated depreciation of $285,000. Now you have 420,000 on this side, 285 on this side, and 520,000 this side. So we first going to add, we're going to add we're going to add 420,000 plus 285,000. That gives us 705,000. So that's the total of these two is 70500, and we have 520,000 this side. So we're going to subtract 520,000. That gives us 185,000. So we have 185,000 on this side. So what is this? This is our gain on sale of building. There is another way of doing it. You take the book value, which is 520,000. You subtract the accumulated depreciation of 285,000. That gives you net book value. So the net book value is equal to 520,000 minus 285,000. That gives you 235,000. So your net book value is 235,000. And how much cash they are giving you? They are giving you the selling price is $420,000. So if selling price is greater than net book value, you have a gain. If selling price is less than a net book value, you have a loss. So you can always remember that way. So instead of this $420,000, you receive only like $220,000, then you will have a $15,000 loss. Okay, so that's the transaction we did on September 1st. Now we're going to do another transaction, which is on December 31st. It says recorded depreciation on follows. Communication equipment is depreciated by a straight line method over a 5-year life with zero residual value. So we have purchased the communication equipment and we recorded the communication equipment with 77,619. So cost of communication equipment 77,619. Life of communication equipment is equal to 5 years, and residual value is equal to 0. So depreciation expense is equal to 77,619 minus 0 divided by 5. So we'll take it 77,619 minus 0, the same thing, divided by 5 is equal to $15,523.80. That will be our depreciation expense. However, I would like to mention that we purchase it on April 1st. So when we purchase, the purchase date is April 1st. And we are doing this on December 31st. So how many months have passed? April 1st to May 1st, June 1st, July 1st, August, September, October, November, and December. So that means 1, 2, 3, 4, 5, 6, 7, 8. 8 months have passed. So this number represents for the entire 12 months. So we cannot take the entire amount. So we have to take the partial depreciation. So depreciation for 8 months would be equal to $15,523.80 divided by 12 and multiply by 8. So that's how we're going to do. So we're going to divide by 12 and multiply by 8. So it's $10,349.20. And now we're going to debit depreciation expense is $10,349.20, and we're going to credit accumulated depreciation for $10,349.20. This we're going to do on December 31st. This piece of information goes to income statement. This piece of information remains in the balance sheet right next to the. Okay. Now we have an office equipment that we purchased for $113,000. And according to this, office equipment is depreciated using the double declining balance method over 5 years with $1,000 residual value. So when we are doing it, so the double declining balance is equal to so what we are going to do is we're going to find a double declining balance formula is cost minus accumulated depreciation multiply by 2 multiply by 1 over useful life. Now, so what is the office equipment they have given us? They said office equipment is that we're using double declining balance method over 5 years with a $1,000 residual value. Okay. I said over there in the formula is accumulated depreciation, not the residual value. We do not take residual value upfront in double declining balance. All right. I am sure you have learned this so the cost for this is $113,000. First year, we do not have an accumulated depreciation because we are doing it first time. So it's 0 multiply by 2 multiply by 1 over useful life, and the life is 5 years. So it's 1 over 5. So the double declining balance for first year is 113,000 minus 0 into 2 over 5. So we're going to take 113,000 multiply by 2 and divide by 5. So first year our depreciation turns out to be 45,200. So I just want to let you know that double declining balance, keep in mind one thing, that we usually use double declining method or double declining balance method for those fixed assets that depreciate quicker than others, just like office equipment, computers, printers, copiers, scanners. These are the fixed assets that depreciate very quickly compared to like a building or a house. So that's why. So that is the double declining depreciation balance for the first year. But I am going to show you how to, but I'm going to show you how to make the journal entry here on December 31st for this one. Is what debit depreciation expense of $45,200, and we're going to credit accumulated depreciation for $45,200. So that's the entry you're going to make on the year one. Let's see what entry you're going to make in year two. So for year two, you're going to use the same formula: cost minus accumulated depreciation, multiply by 2 and multiply by 1 over life. So cost, it will remain the same, 113,000. It's not going to change. Accumulated depreciation will come from last year, which was, we calculated 45,200. So that's the number will go over here. Multiply by 2 and divide by 1 over 5. So this will give us 113,000 minus 45,200 is 67,800, multiplied by 2 over 5. So we multiply this by 2 and divide by 5. That's 27,120. So the first year, our depreciation is 45,200. The second year, we have a depreciation expense 27,120. So the maximum we got the first year, and almost half or a little over than half in second year. So this is our second year depreciation expense. Now for year three, when we calculate, it will be cost minus accumulated depreciation, multiply by 2, multiply by 1 over life. So here the cost will remain the same. Accumulated depreciation from first year 45,200, from the second year 27,120, 2 and 1 over 5. So this time you're going to take 113,000 minus 45,200 minus 27,120, and you have 40,680 left. You multiply by 2 and you divide by 5. So you got the third year will be 16,272. So that's the year 3. Now you know that you have a 5 year, so you will do for year 4. So for year 4, you have cost minus accumulated depreciation, multiply by 2, multiply by 1 over life. So cost is 113,000. First year we have 45,200. Second year we have 27,120. Third year we have 6,272. We multiply by 2 and then multiply by 1 over 5. So when we subtract all of it, is 113,000 minus 45,200 minus 27,120 minus 16272. That give us 24,408. We multiply by 2 and divide 5. So it's 24,408 multiplied by 2 divided by 5 is 9,763. 9,763. So I'm going to show you on another page. So if you have the office equipment, it would be listed on your account or balance sheet is for $113,000, and right next to or right below you have an accumulated depreciation T account for office equipment. So for year 1, you have 45,200. Year 2, you have 27,120. Year 3, you have 16,272. And year 4, you calculated 9,763. Now, you know that the residual is given to you. The residual value is $1,000. So you have $1,000 you have to left. So first you have to do is to calculate all 4 of them. So you start with 45,200 plus 27,120 and plus 16,272 and then 9,763. So your total turns out to be 98,355. So what should be your year 5 depreciation? All you have to do is subtract from 113,000. So you take this number and you subtract 113,000. That will give you 14,645. But you have to leave $1,000. So you add back $1,000. So your 13,645 is your year 5 depreciation. So that's how you calculate the double declining balance. I hope you enjoy watching this video. If you have any question, please shoot me an email and I would be happy to answer any question you have, and I will post these pages for you with the video. Thank you.